Hi, welcome to the Lance Roberts Show podcast right here at realinvestmentadvice.com. Of course, as always, we try to bring to you the latest breaking and best insights into the markets and your money. And today, very happy to have Danielle DiMartino-Booth. She's the CEO of Quill Intelligence, also author of The Daily Feather. I highly suggest that you read her work. Not only is she just very intelligent in the things that she writes about, she also writes so well that it's an enjoyable read. Of course, she also served at the Dallas Fed, so an insider to what actually happens inside the Federal Reserve. So whenever I have a question about the Fed, she is my go-to person to understand what exactly is happening. And Danielle, you and I have spent a lot of time talking about the Fed over the last couple of years. And you know, when Jerome Powell was, nominated as Fed chair, you and I had a discussion on the radio at that point. And you said, well, this guy is a different animal. And so far, he's actually been very much that. Now, I thought it was very interesting here at the latest announcement. Now, maybe it's timing, maybe it's coincidence. But, there was a lot of bashing by, Donald Trump, the president of the United States, against the Jerome Powell in particular, saying, the Fed's gone crazy. They're hiking rates. They're going to kill the economy. Lots of pressure, coming from the White House. In your opinion, did this change in stance by Jerome Powell at the last meeting, where all of a sudden he moved from being very far away from the neutral rate to now being much closer to the neutral rate? Do you think that was some pressure from the White House finally weighing in on the Fed, or do you think, honestly, he's just following the data?
Well, I think that the optics of the moment were very, very poor, and it definitely made it look like Powell was kowtowing to the administration, to Trump. What was potentially more damning to me was that the financial stability report hit the wires about an hour before Jerome Powell took to the podium. And that was basically an out for him. It gave him cover to potentially pause in the rate hiking cycle, not in December, but come the spring, come the March meeting, under the auspice of the fact that it's apparent that problems in the corporate bond market are beginning to rear their ugly head. I think it wasn't Trump as much as it was the General Electric bond moment that really shook Powell to his foundations. He has a background in the financial markets, as we both do. And I think when you see an investment grade company trade within a matter of hours to being that of a junk rated company, that should wake you up as somebody who has a duty to ensure financial stability in the financial system. Right.
And I do. I absolutely agree with you that, the optics look very bad. And again, as I kind of, preface this, was it just coincidence? And I agree with you. I think it is that it was just bad timing, And also, too, if we take a look at a lot of the economic indicators, the Fed's been hiking interest rates. And again, part of the reason that the Fed hikes interest rates is to kind of quell economic growth and inflationary pressures, right? So they're worried about inflation running too hot, too fast. So we raise interest rates to try to slow that down a bit. But, recent economic data coming out of the housing market, auto sales, and really even in the corporate bond market across the board, we've seen a lot of companies being downgraded into junk-rated status. That certainly had to weigh into this decision that, we're potentially closer to the neutral rate than we were just a month ago.
I think that is the case. I'm intrigued by the market's initial reaction to Powell's remarks. It was as if the bulls said to themselves, wow, we've got the next iteration of quantitative easing right around the corner.
Right.
And I think that Tuesday's market action, when the differential between the 2-year and the 10-year treasuries breached 10 basis points, 1/10 of a percentage point on the downside, we saw the Dow gap down from being down 200 to being down 700.
Yep.
I think that was more of a recognition that, wait a minute, if the Fed sees justification in pausing in its tightening campaign, then it sees the economy is slowing, and maybe that's not such a good thing for my stock portfolio, for my risky bond portfolio.
Right. Well, and to that point, while you've been watching this, this move by interest rates, it was actually quite surprising on Wednesday. And let me tell you why it was surprising to me anyway. If we go back and look at the correction we saw back in early February, markets were down 10%, and yet interest rates pretty much held firm above 3%, even though the markets were declining. Usually we would see kind of a risk-off move, money coming out of stocks, going into treasuries, kind of a safe haven play. We didn't see that occur. We also didn't see the volatility index spike a whole lot in October and November. During that decline, volatility remained right around 20, its long-term average. Gold really didn't see a whole lot of shine. And interest rates, again, really kind of remained pretty flat. It was interesting on Tuesday with this kind of realization that, wait a minute, the Fed saying they're going to stop hiking rates, that may be worse than what we think it is. All of a sudden, we saw a big rotation into the 10-year Treasury. We saw that rate drop very, very sharply. And that's the biggest move that we've seen, I think, since like 2011 in the 10-year Treasury. And I think the market may, to your point, I think the market may have woken up that there may be more risk here than what we thought before.
Absolutely. If there's one thing that occurred to rate traders, these are people who make their bread and butter off of trading interest rate type of securities, was this past Friday's trading that the 10-year finally closed at a yield below 3%. The 10-year closed at 2.99% on Friday, and that really did shake up confidence, because regardless of what the market's machinations were, whether you're talking about January and February or October into November, that 10-year seemed to be holding that 3% line like it was life or death.
Right.
So that Friday move in the 10-year really was the first shot across the bow, the first recognition, again, that the Fed is trying to broadcast that if it's going to stop tightening, it's going to stop tightening because it no longer sees an economy that is at risk of overheating.
I find it also interesting that, look, there's the bullish bias that currently exists in the market has been one that's been kind of, you kind of watch it in awe in a lot of cases. I mean, it doesn't matter what the market does. Everybody's just simply, just buy and hold. This market only can go up. The Fed's going to be, anything that happens, the Fed's going to be there to bail it out. And I think it's been interesting that the market's actually been holding up fairly well this year under this premise that the Fed is there to backstop everything. Yet the Fed is accelerating their roll-off of their balance sheet, $50 billion a month. Now you look at central banks globally, you're starting to see a contraction, either a reduction or a contraction in the liquidity they're providing at a time where we now see global economic weakness, kind of swirling around the globe. It hasn't really seemed to settle back here at home yet, but it certainly seems like it may be in the early stages of doing that.
I certainly think that it is, and the realization is that we cannot be immune to a global growth slowdown indefinitely. And the recognition thereof, as well as the fact that Lael Brainerd, who's she sits on the board, she's one of the veterans. She came out a few days ago and said that she anticipated that the record run rate of $50 billion a month of quantitative tightening of balance sheet runoff was going well and was anticipated to continue to go well. That states that even if there's a pause after the December the 19th rate hike, that this $50 billion a month is going to continue, even as you note, by December the 31st, we see the European Central Bank go into net negative territory in terms of expanding its own balance sheet. Some of Quill Intelligence back of the envelope calculations show that for every $200 billion of quantitative tightening here in the United States, we get the equivalent of 125 basis point rate hike.
Wow.
So that means that even if the Fed is on pause for all of 2019, we would still have 3 rate hikes baked into the cake if they were to continue on their quantitative tightening path, which is why so many different countries, emerging markets, governments have implored the Fed to revisit that policy and also take its foot off the accelerator and slow down the pace or completely discontinue the pace at which it's executing quantitative tightening.
Now, hold that thought. We're going to take a quick break. I want to come back with you. I want to pick up right there, and let's talk a little bit about Jerome Powell. We've had lots of conversations about him being the different animal. And, here we are. We've got the markets almost begging, please stop. But do you think they will stop? Do you think that they will make a change in their monetary policy? And I also want to come back and revisit a little bit about tax cuts and trade wars and how all this kind of all ties together into what may be a bigger market risk in 2019 than what a lot of people expect. We'll be right back with Danielle DiMartino-Booth, CEO of Quill Intelligence. Don't go away. We'll be right back.
Got a question for Lance later? Ask now at realinvestmentadvice.com.